All right, I'll jump on that in a minute. All right, we're going to go ahead and get started. Thanks for joining today. I'm Major Hilliard, international best-selling author and founder of MH Estates Capital Partners, where we purchase and acquire value-add manufactured home communities, and we develop them into awesome asset recession-resistant assets that we then sell for maximize profit for our investors. Today, we're going to go over a little bit more over what we talked about on Tuesday, which is about aviation and how my journey into getting my pilot's license has actually transferred over a lot of lessons over into and how they can join with investing in mobile home parks. So we're going to kind of dive into it a little bit, take a little questions up front, and work our way through. So on Tuesday, we talked about how in aviation there's a lot of collaboration and correlation between how we invest in mobile home parks when it comes to planning, understanding your mission, and knowing your route, having the correct licenses, and then be able to scale efficiently, and how those two transfer over. It's pretty common. I'm going to open up the chat real quick, and if anyone has questions, go ahead and throw it in there. I did have a few already before we came on from others during the week, and I'll go ahead and start with a popular one. Is um, I was asked, Major, how do you finance parks, and if financing or ownership is kind of transitioned over or kind of and it's similar with aviation? And there is kind of a correlation there. Obviously, it's an income producing asset, so you can go with a commercial way of getting loans based off of a chattel or what have you, but more of a commercial line based off of your projected income. But there's also fractional ownership, which is interesting. So in aviation, you can actually buy shares of a plane, just kind of like you would do with a timeshare. You buy shares and you're able to use the aircraft as needed. You share the cost of maintenance across with each other, and it lowers your cost of ownership and maintenance and maintaining the actual aircraft. But when it comes to investing, so there's a fractional there, and with investing, it's essentially partnerships, it's equity distributions, equity splits. And so what we have is with our partners in our fund, we have a large equity split where the pool of investors get the lion's share, 70% of the equity over the entire portfolio of all of the acquisitions that we have and parks under our management, where the other 30% is for myself and partners that own and operate the actual fund and operate the communities within the portfolio. So there is a correlation there where it's kind of fractional, but it's split up. It's based on income or money produced and offering at the time of investment. So there is a correlation between those two. Another question I get about is with licensing. If there's a stature or way with mobile home parks, because you have to have a dealer's license in order to sell X amount of homes per year. If there's a tiered system to get to that license, like with aviation, where you start with your single engine, you can work your way to instrumental and then dual engine and up to commercial. Well, yeah, with mobile home parks, there's a couple different licenses that you can have. You can have your setup license, which allows you to set up the actual home on a lot that's really ready and available to sell. Then you have a salesperson's license, which allows you to sell the actual home, not to do any setup or construction or work on the home. The other one is a repairs license that you can actually repair the home, manufactured home, but you're not able to set up or sell it. And obviously, the dealer's license is the top notch, and that's the one we have in each state that we invest in is a dealership license. That allows us to do everything. So we can control the setup, we can do any repairs as needed, we can purchase directly from the manufacturer off the assembly line and bring it into our communities, and we can actually sell every home that we have in our parks. And that allows us to cut out a lot of the middlemen, a lot of the uh, third party reliability, which can really delay things, and allows us to go straight to the source. And it keeps it more efficient, more cost effective, and allows us to have our tenants have the best uh, ability to purchase an affordable home. So another thing, another correlation between is planning. So when commercial real estate and especially with mobile home parks, it's what we call due diligence period and then closing period. So in the beginning, it's just like with a house, you have an inspection period. So you consider that your due diligence period. But during the due diligence period, that's your upfront time that you have. Basically, you're against the clock to do all the reports, all the information you would like, all the investigations that you want to do on each property. You get your financing set up. You have your inspections laid out, your surveys done, all those things done up front to make sure it's a property that you actually want to buy. Because at the end of that term is your closing period. And what happens is, usually when you purchase these communities, you're going to put between 5 to 10% down as an escrow deposit. And so that's an escrow deposit, like with a house, that you're going to hold it with an attorney. And that's basically there. And then once you go past your period of due diligence, your money will go hard, meaning that the money is non-refundable. So essentially, on a $5 million deal, you can have upwards of $200,000 to $500,000 sitting in escrow. And so you want to make sure you go through your checklist and that you do all of your due diligence up front before your money goes hard, because it's non-refundable, and essentially you know you're going to close at that point. Just like with aviation, you've got to be able to have your correct flight path first. So all the research is done up front. You don't even, the majority of the work's done before you even push that button to engage and turn over the prop, and then and what have you. But once you get into it, once you get in the air, you've got to be able to get to your destination. That's where closing comes in on our parks that we buy. So we've already had the financing set up, all the reports are done, money's hard, it's non-refundable, and we already have a path of progress. And we already have our management team working on getting all the accounts and software updated to include all those units, have the tenants converted over, and we have letters that we send out day one of closing, letting the tenants know that ownership has changed and that management has changed. So it allows for a smoother transition, and by acting right away and being upfront before we close and having those items set up, it allows for a smoother transition, which leads to lower turnover, and it leads to more income and less operating expenses. So it all correlates together. And just like with flight planning, you've got to look for any kind of climate you're going to hit or storm systems that you're going to encounter, and be able to adjust the flight path and have alternate routes, and make your adjustments then. Also, you got to calculate how far you can go with your fuel before you need to touch down, refuel up, and go out. And you've got to have reserves in order to get there as a backup as well. And then course correction. So obviously, you can plan all you want, but when you're in that air, you've got to make a decision. You've got to go work your way around weather. There could be no-go zones. There could be other planes in the area that have a same path. You've got to make an alternate route, and that comes across with any type of investment. You've got to be able to adjust and deal with the adversity that you're dealing with. And so we've come across everything, but we always keep reserves. We usually keep 10% or more percentage of reserves in account that we can use for any kind of hiccups, because even with all the due diligence, there's still going to be things that come up no matter what you do. And just like if when you bought a house and you think everything's great, your home inspection's great, and then you get in and the dishwasher blows up on you, or the electrical sockets that were missed that don't work. So there's always going to be something unforeseen. And if you can mitigate your risk as much as possible by getting the right information done up front and all your evaluations and all the reports you can, you really minimize your risk, and it allows you to deal with those hiccups pretty easy. Um, so yeah, we've come across plenty of them with our experience, and over the 14 years that we've been doing this, we've had a lot thrown at us. We've dealt with it all. And I always believe in a rule of three. I always have three solutions to every problem that we come across. And then, yeah, you go with the most cost effective and the most efficient method that's best for the property. That Because if it's best for the property, it's best for our tenants. And when it's best for our tenants, they become paying tenants, and paying tenants is how we get our profit. So there's others that take a reverse approach. They just pound numbers at it and do or die. And that's how you can have a lot of turnover, a lot of tenant dissatisfaction, which will ultimately hurt your rents and your collections. So by doing what's best for the property, it's actually what's best for the tenants. And by what's best for the tenants is actually best for us and our partners, because that's how we get our really big profitable returns, our huge cash outs and liquidation events when we sell, and really good steady streams of income and cash flow on each one of these communities. So a couple of other asked questions I get is that, how is multifamily compared to mobile home parks? And it's kind of a night and day difference. So Let's get on the commonalities. What's common between the two? Well, they're both rental assets, right? So they're both getting rental income, and there's different sizes, there's different class levels. So in apartments, is considered more of a class A alphabet class. So there's a class A, B, C. And in mobile home parks, it's a star class, kind of like you have with hotels. So it's a 4, 3, 2 star parks. And so they're very common in that aspect. Where they're not common is on the type of management, your operational expenses, and then renovations and disaster relief. When it comes to multifamily, the management is extremely high. It's extremely intensive. And in fact, the biggest indicator of this and how it's kind of shocking, the US, United States average for the past 5 years running, it's actually been worse. The US average is around 48% turnover on all multifamily rental units. So if you have a 50 unit apartment complex, 25 of those tenants are going to leave, and you got to fill out those vacant 25 units. So you can see that's extremely intensive management, and a lot of operational expenses, because when the tenants leave, you're going to have to fix the units up, clean them, refurbish them, and then market them to have them filled. And there's a lot of lag time. You can lose 2 to 3 months worth of rent. So if you're losing on 2 months of average over 25 units, that's 50 potential income sources and monthly income payments that are gone. And so when you compare it to mobile home parks, we have a 10% turnover. In fact, on financed homes, it's even less. It's a 3% turnover. So that huge difference is a 30%, 40% difference of turnover. Has management is way less intensive. And the reason for that is that with multifamily, the tenants are renting the units. So they still have to maintain all the water, heaters, the refrigerators, flooring, windows, anything that goes wrong, they have to maintain it. With mobile home parks, the tenants actually own their homes, and all they're doing is leasing the dirt, like an RV park. So if you're familiar with commercial, there's triple net leases for commercial buildings like retail and office centers, where essentially like a Walmart is leasing the land. They've built the building and everything else. And then when their lease is terminated, they either renew or they leave, but the building stays there. Well, it's the same thing with mobile home parks. They're leasing land. So it's essentially a commercial triple net lease for an actual home that a person lives in. Now they can pull their home off, but it's usually pretty expensive, and it's rare that they do, tenants do, because not only is it expensive to move the home, now they have to have a place and space to actually move the home to. And because these parks are not being developed very fastly, or being developed way less than they are being torn down, there's a real scarcity factor. So there's a lot less supply than there is demand. And so it really keeps these homes put. And it's on average that tenants will stay in our parks well over 10 years. So your management is way less. Your expense load is way less because all you're doing is maintaining the utilities. So the water lines, sewer lines, electrical lines, and the roadways and light and the street lights. That's essentially it. The rest is on the tenant because they own the home. Where in multifamily, you have to maintain everything. And even worse with multifamily, if there's a fire, water flood, or a broken pipe, it'll affect not only that one unit, but all the units surrounding it. So the units above, to the side, and below. They'll have to go through insurance and renovating those units and bring them back up to where they're marketable. It's extremely expensive, and even more worse, it's more time hassle. So it can take months in order to get one unit back up online in order to market. However, with a manufactured home, because they're horizontally built, they're built across a large space of land with their individual lots. If one catches fire, which we've had before, has water damage, or what have you, it affects just that one unit. And we're able to, we can replace that unit. We can have the unit pulled out or demolished and replaced within 2 weeks. Now, it got a little worse during COVID. It might take a month or so, but it only affects one unit, where multifamily is affecting multiple units. So those are great factors that can keep into consideration why we love mobile home parks and why it's considered the lowest maintenance, least operational expense intensive asset that allows for cash flow, large liquidable gains and profits and revenues on the back end. And we can just continue to build out our portfolio. So with our current investment model, we purchase value add communities. Value add meaning that there's a lot of space to add value through either renovations, increases of rent, adding new amenities for better revenue stream, additional revenue streams like cell towers, satellite leases, laundry we've even seen as well. And so we hold these assets for 5 to 7 years, and that allows because we build portfolios of larger portfolios of actually of parks. So we strive to have between 400 to 500 pad count in each portfolio, and a portfolio meaning a consortium or a um, assortment of communities that we own that are within an hour and a half to 2 hour drive of each other because it's easier to manage that way. So when we have target markets that we like, select markets that are very hot, that are very expanding, population growth, there's a lot of industrial work, a lot of job demand for blue collar workers. We hone in on these target markets, and then we go even deeper and we purchase communities that have a lot of value add. And then we combine them together to make a larger portfolio. And that is where you get your maximized amount of value, market value when we go to sell. We'll combine them together, they're all stabilized, sell it, and that's how we get their biggest returns. And the other thing is the tax benefits. There's accelerated depreciation on mobile home parks. And then because we're buying value add, we're doing renovations and upgrades to the community that are able to defer tax gains as well. So because of the accelerated depreciation and the capital expenditures, we're able to offset majority, if not all of our income, our cash flow on these parks throughout a good portion of the life that we hold them. And so that's another thing that passes on to our investors that they love. And they use it not only for the income with us, but they can use it across their entire tax situation. So we have other properties that we're dealing with right now. We just closed on small portfolio. Well, I say small, it's 133 pads and 4 parks in Columbia, South Carolina. We're looking at a few right now in Spartanburg, South Carolina, to finish our portfolio. So what we have with our investors is that we have 12% annual IRR is our targeted IRR. We have 7% pref, and then we have an equity split with a 70-30 equity, 70 to our investors, 30 to ourselves. And allows us to get the best of both worlds. You can get some great cash flow and even bigger equity distributions on the back end, but you're also getting all those tax benefits for the life of your investment. And yeah, so the best way to get a hold of us is to do these webinars. I'll be in these webinars every week, every Tuesday, Wednesday. There'll be some exceptions. You can log on to our website and sign up for a call. You can schedule a call with myself or Larry, a CFO, who can answer any questions you have. You can also speak with my AI. I don't have the QR code up here. I'll put it next time. But there's QR codes that I can have that you can go speak to my AI, and it'll actually speak to you as I'm speaking to you right now. So you can type in your questions or actually speak into your phone. It'll use my voice and answer any questions that you have. There's so much data and so much information with this type of asset. It really was kind of unknown or not a stereotypically liked asset class until prior to COVID. But once COVID happened and it became well known that mobile home parks were the highest rental retention asset and least maintenance inducing and operational costs requiring asset across all rental assets, it's really jumped out of the catch jumped out of the bag, and a lot of attention has come to our market, and we're seeing prices starting to show that and reflect that, and that's how we're able to get these large gains. Because, and again, biggest factor is supply and demand. The demand for affordable housing keeps skyrocketing every year, and because supply is so limited, really with our communities, they appreciate each year without even doing a whole lot of work to it because we're just servicing a need that's so vastly needed, and we're the best option in every town, every city, every county that we invest in. We are the absolute best option for value of life and for a cost-effective way of living. That it's just really driving up prices for each one of our communities and market value, and that all passes on to our partners and our investors, and that's what we're here to do. But yeah, go onto our website, schedule a call with myself. You can speak with my AI. I'm going to put some links in the below here that you can look into our AI. And then, yeah, we'll be doing videos, lots of videos. You can check us out on Facebook, LinkedIn, TikTok, and Instagram, and YouTube as well. Check out all our videos. We're putting out a lot of content. We really love what we do. We want to help out. This is a huge need, and yeah, appreciate your time today. We'll speak soon. Let me do the